Okay.
Yeah, I was going to ask that because when people say interest rates is low and they want to get the same rate that their friend got, I'm like, what's your credit score at the time? And there's something called debt ratio, debt to income ratio, DTI. How do you guys arrive to DTI?
So I'm glad that you asked that because there is some changes coming effective May 1st.
Welcome to Sold 100 TV.
All right, welcome back to Real Estate Talk Show. This is Dr. Billy Okoye, your real estate doctor. Today we're going to just dive in and welcome all our guests that we have. But today I'm going to have our associate broker, help us out as we talk about mortgages. And we have no other person but Martin Okoye. Yes, we have the same last name. She's my wife. Can I have her just go ahead and introduce herself?
Hi, I'm Montane Okoye. I'm a real estate agent and associate broker and Virginia broker at Sold 100 Real Estate. I'm licensed 19 years and representing primarily buyers and sellers in the Maryland, D.C., and Virginia area.
And today, talking about real estate mortgages, no other person could have done justice to this topic other than it's somebody who's got a lot of experience in this industry, and I'm going to let him introduce himself.
Thank you, Billy, for having me. And thank you, Matinee. My name is Paul Defngin. I'm with Celebrity Home Loans. We're out of Rockville, Maryland. Celebrity Home Loans is a corporate nationwide company, but we have multiple branches here in the region.
Very well. Very well. So, again, this is a real estate talk show, and if you guys have any questions, just quickly go ahead and subscribe and, leave your comments leave your questions on the comment tab, and, we'll make sure we'll get it answered today. So today, we're just since this is mortgages, we want to talk about the real estate industry. I mean, what's going on? What are you seeing what's the market trend right now?
So the market trend, it has still inventory is still very low. It's still challenging for a lot of home buyers. Interest rate have started to improve, and we are seeing more buyers now, more pent up. So I think that spring is going to be a good market for all of us, hopefully, because we're starting to see interest rate come back down, and a lot of people have been sitting on the fence are now starting to get in the market.
And what's the average interest rate you're seeing right now?
So interest rate can be anywhere from low 6, sometimes could be below 6%, depending on credit or the situation for the buyer.
Okay.
Yeah, I was going to ask that because when people say interest rates is low and they want to get the same rate that their friend got, I'm like, what's your credit score at the time? And there's something called debt ratio, debt to income ratio, DTI. How do you guys arrive to DTI?
So I'm glad that you asked that because there is some changes coming effective May 1st. So this is really specific to conventional loans, Fannie and Freddie backed loans where they're purchasing this type of loan. So come May 1st, the two entities who purchase a lot of these loans, they're making it a little bit more expensive based on if your debt to income ratio is above 41%.
Okay.
So if anyone is looking to buy a home, the way they're looking at it is if your debt to income ratio is too high, above that 41%, you're going to pay a little bit more in cost. And that's simply because of the pricing adjustment that those two entities are implementing come May 1st.
Do you think it's because somebody that has more debt might be more of a risk to
Correct.
Okay.
That's correct. So it's all risk-based. That's always been in place. The loan level pricing adjustment is something that's specific, again, for conventional loans. It's not related to govy loans like FHA, VA, or USDA, but this is really conventional loans, the loans that are purchased by those two entities. If you are low credit score, you're probably going to see a little bit better pricing because the mindset behind this is that they're trying to help more market the people that did not really have an opportunity to buy a home, actually buy a home. The ones that are have higher debt to income ratio, that's a little bit more high risk to the two entities, so they're going to try and implement those changes come May 1st.
Very interesting. No, I was going to say, and I know you talked about conventional versus FHA, but can you tell us a little bit about what an FHA mortgage really is, and what is FHA, and just so the
Yeah.
viewers can know.
So there's different loan products. You have conventional, which is the loan that I just mentioned, which is purchased by Fannie and Freddie. Then you have FHA. FHA is insured by the government, Department of HUD. That is specifically for someone that wants to go in with less down payment. It could be a first-time home buyer or repeat buyer, 3.5%. It does, because it is insured by the government, the insurance on it is pretty straightforward. It applies to everyone. But that loan is a way for someone to get into a home if maybe they didn't have the down payment or their credit is a little bit marginal. They can use FHA to get into a home.
Okay. All right. So primarily, this talk is for home buyers, and the questions we always get is, what should I do first? I mean, is it a good thing to get pre-approved first? And if so, what are the process of a pre-approval?
Yeah, that's a great question. I wholeheartedly believe that purchasing a home, you really want to get pre-approved first. The reason you want to do that is, one, you can talk to the lender and really come up with a plan with your budget, of course, your budget. But it's also a way for you to discover if there's anything that we need to address up front.
Okay.
Like any hurdles, like credit, more saving. We can talk about that and plan forward. The other thing is that getting that pre-approval, when you're going with your agent, like the two of you out there and you're presenting your offer, you're going to have the confidence that you've already gone through that process, making sure that the lender has checked all your income, your credit, your savings. If there's not enough savings, we can explore other options, maybe like a down payment assistance, closing cost grant, or something like that. That would help someone get into a home. If you just go out there and not get pre-approved, you're just going out there without really having the mindset that you need to know what you can afford, right? So.
And do you do that, Paul? Because I know some I've had situations where people are pre-approved and you have a pre-approval letter, you go out and you show them all these homes and they go under contract, and then within the first week you find out, they can't qualify for the house. So what is your, what, I know you touch a little bit on it when you answered the question, but what are you actually checking for?
Yeah, so there's one way that people say they're pre-approved. They go online, they put in their information, and then you generate something. Like you're pre-approved, right? We do it a little bit more. We dive in a little deeper.
Okay.
Just having the conversation is the first step, and kind of know what your goals are, what your budget is. But then I also require that we see everything. Like you have to support it with your documents. Right. And you have to give us permission to review your credit profile. Without looking at that credit profile, you might say, my credit is from Credit Karma, which, by the way, it's totally different than what lender use. Credit card company will also give you your credit score. That, again, is also different than what lender use.
Okay.
So you guys pull differently.
Well, it's not that we pull differently. It's FICO is what most lenders use, right?
Okay.
And FICO, if you know FICO model, there's multiple model in FICO.
Okay.
You have the car model, which could be FICO 2.
Okay.
Mortgages usually follow like FICO 8 or something like that.
Okay.
And it can vary from one lender to another, but there's multiple layers of FICO. Most of the credit card company will use something like a Vantage score, which is a totally different model.
Okay.
Credit Karma is well known for that. They use Vantage score. That's never going to be the same, right?
But it shouldn't be, maybe, is it 10 points off, 20 points off? Credit Karma can't be telling me my credit score is 700 and it's actually 550. Does that happen?
Well, not 550, but it could be like you're at 700 on Credit Karma.
Okay.
And when the lender pull it, you're at maybe 640. It could be, right? Because it's totally different model,
Okay.
right? I've had like people say, well, my FICO is this. If they're getting it from like a consumer-based model, that's not necessarily what we're going to see, any lender is going to see, because it's going to be different. Good example, I had a good friend of mine like reach out to me because he applied for a credit union line of equity. And he said, credit union was telling me my FICO was 656, and I pulled my own FICO and it was 700 something. So I said, forward me the report, and when I looked at it, I said, well, if you look at that report, different model. You have FICO, which was 656. I put it out to him on FICO 2, and then if you go to FICO 8, it was actually like a little bit higher, or vice versa. I can't really remember which one, but they're different. They're always going to be different.
Okay, so what are the things that you see in people's credit that really draw down their credit score? Student loan, car note, foreclosure, bankruptcy. How does this affect their credit score?
Yeah, so really the credit scores are really driven by your payment history. That's about 30%, maybe 30, a little bit more than 30% of your credit score is driven by how you pay your bills. So, which is number one of the C's when you're applying for a mortgage, right? It's credit history. Like, are you a responsible person paying your bills? All of those things that you mentioned, Billy, could happen. No one wakes up in the morning and say, I'm gonna go file foreclosure, right? Sometimes things happen. If that does happen, of course, that's gonna impact your score. And it may impact it for at least 2, 3, 4, maybe even as long as 10 years, right?
Okay.
If you were talking about like a major event like that, bankruptcy or a foreclosure. But for the most part, really what really drives your score is your payment history. That's number one. And then number two is the uses of like your credit.
Credit
You
line.
maximize.
Like the amount that you're
Exactly.
using. Okay, so like if you have $10,000 and you're using $9,500, that could affect
You're
your credit.
maxing it out.
Right. And by the way, if you use $9,000 but you pay it off in full, that's okay. But the one thing, there's a misconception of like, I use my credit card and I pay it off every month. That's great, but when you're talking about getting pre-approved, you want to get that done a month earlier before you actually go get pre-approved if you want that score to be as high as possible. The reason why is the credit bureau is they lag time about 30 days. So like someone would call and say, I pay off my credit card every month, but they just made that payoff maybe a week or two ago. That's not going to be reflected on their credit score when we look at it. So that's a little inside thing.
That's important to know. I never knew that. I just thought that once I pay because I do that. I charge a lot, like on the business cards for points and things like that, and then pay it off at the end of the month. So you're saying that if you're doing something like that, especially if you know you are doing something where your credit will be pulled, you're purchasing a home or something like that, maybe wait 30 days before you go ahead and get the credit, before you charge it up and load it up and pay it off.
That's right. Or the other way is maybe like if you know your statement cycle, let's say your credit card, like you mentioned, it comes out on the 15th. You want to pay that off before the following 15th of the following month, right?
Okay.
And make sure that you don't have anyone look at your credit until you've gone past that.
Okay.
Because then when that credit was pulled, it'll reflect that you made that payment. Because if you just do it within that small window, you're going to see that your score is probably not what you're expecting, even though you pay your bills all the time.
That's a very good point.
Okay. So another question that we have here, one of our viewers has sent in, is down payment and closing costs. He said, what are the 3 main buckets of cash that home buyers need to know so that they can save or prepare when buying a home?
Yeah, that's a great question because, for most first-time home buyers, when they're online, they get excited about buying a home. The only thing that they're focused on is, can I come up with down payment, right? That's bucket one. That's what I call bucket one of cash. Most people think about the down payment, but there's 2 other ones, which is closing costs and taxes and insurance. Those are bucket 2 and bucket 3. And I explain it in a very simple way. If you're buying a home as a first-time home buyer, the minimum required from you, unless you're a veteran or you're using what's called USDA, USDA is specifically for rural area property. Unless you're in one of those 2, most of the time you're going to be required to put at least 3% down. So that's the minimum, right? So bucket 1
For
is
a conventional product.
For a conventional product. For FHA is 3.5. So if you're looking to purchase a home, you're looking at right off the top 3.5%. That's the down payment as a first-time home buyer. in this area, and you guys know this, like closing costs is about 3%. If you're not thinking about that, then you go make an offer and you weren't prepared. Again, if you're done online, no one really walked you through it. You're gonna be surprised, like, hey, where's the other 3% coming from?
Yes.
Right now we're in a market, maybe you could negotiate some of that, but you
We've
want to
been
go
seeing
at
that.
it like prepared,
Okay.
right? And then the last bucket is the tax and insurance, and that's about 1.5%. It could be a little bit less, but I always use that 1.5 as a standard, because if it's less, great. You go ahead without any surprises.
Good.